Well, welcome back. We see the financial stocks dragging on the markets today. Lots of red after the Federal Reserve says banks will no longer get a break on the amount of capital they have to maintain. Let's bring back the All-Stars, Carol Roth and Gary Kaltbaum, for more on this. And I don't want to disappear in the weeds on this issue, debating supplementary leverage ratios, SLRs. So, Carol, I only said that because it's on the prompter. I have no idea what that is. But so, Carol, is this a big deal and why?
So again, without trying to get in the weeds, I think it's really a communication issue that's the biggest issue. The concern is that there were these relaxed requirements during the pandemic that were set to expire at the end of March. And everybody thought, okay, well, they're going to extend it. But the Fed now on the 19th of March lets everybody know. And the concern is that the banks who might not be well capitalized would have to sell treasuries. That puts pressure on the treasuries and increases the yields. So again, I think it comes down to this communication issue. Every time the Fed says something, the market goes haywire because they don't do a good job of effectively communicating it. If they knew they were going to let it expire, give everybody some time to digest it. Don't dump this into the market 11 or 12 days before the end of the month.
Yeah, it's interesting, isn't it, Gary? 11 days notice. On the other hand, could you argue that this is a sign that things are starting to stabilize, although these things were put in place to take the volatility out of the market? But having said that, if the Fed thinks it's no longer needed, could you argue that that's a good sign that things are on the up?
The Fed letting it expire means maybe they feel better about things, but we saw Powell this week say we're keeping rates at zero and we're going to print infinitum $125 billion a month, along with his ECB counterpart, the same. So I still think they're going to be easy money. The big thing with banks, they've had this big run because keeping rates at zero by screwing over the savers and watching yields rise to 1 3/4 on the 10-year, that increases their margin, which increases their profits, which perception on the stock market is prices are going up. And that's why you've seen the banks, and especially the regionals, soar big time over the last few months.
So, Gary, to follow up, are savers, those people who take the money and they put it in the bank and have gotten absolutely nothing for it, are they finally going to see some reward for their savings?
No, we're still at zero. And the good news is at least we're not Europe, where if you deposit money in the bank, you have to give them a toaster with the negative rate. So, look, I think it's a sin. I think it's a shame. I cannot believe more people are yelling and screaming about this because all they're doing is handing money over to the banks and lenders that should be going to the citizenry, but seems nobody cares right now.
I know Gary is not a huge Fed fan, at least not the policy right now. Carol, do you agree with Gary? Has this gone on far too much, for far too long and for far too much?
You know, Ashley, I always like to argue with people, but Gary makes too much sense here. I mean, absolutely, this has been a wholesale selling out of Main Street to Wall Street. And the fact that in order to find any yield, you have people, retirees, people who are trying to retire, chasing risky assets. And those assets, like junk bonds, have yields on it that are so low that don't properly compensate you for the risk that they're taking. The Fed has completely disrupted risk in the market. It's way past time to normalize. But if they feel that things are getting back on a solid footing, and with all of this extra stimulus that they're throwing in here, I hope that rates will start to move up, because that is normalization. That's where it should be. And to get things back to more normalization and free markets and stop with the interference in the market is something that's incredibly important for our country.
Yeah, but so many are addicted to that punch bowl of cheap money swashing around. It's hard to get off of that. But anyway, it's going to come at some point. Gary, Carol, thank you so much for joining us and coming back again for your thoughts. We do appreciate it.